Wow, this stock just went absolutely beast mode. About a week ago on this channel, I shared with you the first stock I had bought in over half a year. It then jumped as high as 40% in one day a week later after reporting their Q3 earnings. So the purpose of today's video is twofold. First, why did it just jump so much? And two, the age-old question, is it too late to get in? Oh, by the way, none of this is financial advice. But I hope to answer both questions by the end of this video by sharing annotated transcripts, investor presentations, and revisiting our comps tables, so let's do it. My name is Matthew, and if you like new stock picks and in-depth research, make sure to subscribe. And today, we are talking about Lending Club, ticker LC. In today's video, we're first going to do a quick recap on my bullish thesis for LC and why I bought in the first place and really what they do. Second, we'll review their Q3 numbers and ask why is it up so much. And finally, third, we'll revisit the comps table, the valuation, and see what I'm doing with my position, if I'm buying more, what is going on. As a quick disclaimer, I do of course own shares in Lending Club. This is my position of about 140 shares, up 27% so far. And these are my buy sell alerts to the investor community over the past week, as well as I continued to buy into this position. I actually increased my position by 40% after hours, just minutes after their numbers were released, and it was still up only 7% because the numbers were so good. It's a very rare after hours move that I shared with the community in real time. And lastly, I shared an exclusive video for the community on due diligence on Upstart's tech versus Lending Club's tech in the days leading up to the report, which I definitely think helped people build some more conviction buying in prior to earnings. Anyways, if you would like, you can check out joining investor community down below in the description or in the pinned comment. It's less than $1 a day if you think it's worth it to you. All right, so super quick, a refresher on what Lending Club does and why I initially bought it. Lending Club is a fintech and bank hybrid. On the fintech side, they use their proprietary AI and machine learning risk model to assess credit risk, which is very similar to what Upstart does. This helps them originate, aka find, different loans. Their risk model has resulted in 50% lower delinquency rates compared to their competitors amongst prime borrowers, and 80% of their loans are now automated versus Upstart's automation rate of about 70%. On the bank side, they recently acquired Radius Bank, one of the best online banks, in February of this past year, which completely changed their business model, and this is a big reason why I bought in. They can now operate as a bank and both fund and retain the loans that they originate, which if you don't know what that means, it's okay. Just know that they generate recurring revenue, they are vertically integrated, they have much higher profitability, a gold mine of data to improve their risk model, and of course, it's a key advantage over Upstart and SoFi, who cannot operate as banks, at least not yet, although SoFi is working on a bank charter. My last video on Lending Club breaks all this down in more detail, but let's keep moving. Lastly, their bread and butter is issuing unsecured personal loans to people, mainly to pay off their credit card debt. They also offer auto refinancing and buy now, pay later services as well, which they're just now starting to ramp up. Lending Club Bank, which is the rebranding of Radius post-acquisition, also offers things like checking, high-yield savings accounts, and more. Finally, to wrap up my bullish thesis recap, the stock seems simply undervalued relative to its peers. So keep in mind, these numbers are from October 18th, a day before I posted my first video, and this is to show you the numbers I was seeing when I decided to buy. It was trading at a 3.8 times next 12 months EV to revenue versus Upstart's 32 times and SoFi's 13 times. Why is that the case if it has a massive advantage of being able to operate as a bank, the benefits of which I just listed, and it seems to have virtually the same AI and machine learning capabilities as Upstart? We already compared their automation rate with Lending Club at 80% and Upstart at 70%. And Upstart claims that their moat or advantage for their AI model is that they have an 8-year head start over everyone else and they have 15 billion cells of data. Well, Lending Club has been collecting data since 2006, which is 15 years, and they have 150 billion cells of data, which is 10 times more than Upstart. Furthermore, at the time of buying my first shares, Lending Club showed basically the same, if not better, growth rates and the same revenue projections for next year, and Lending Club's margins were worse than Upstart's at the time of buying, but they will continue to get more profitable as the bank segment matures, as we've seen already. It didn't make sense for it to be so cheap, and actually, Lending Club just raised their full year guidance, which is a perfect segue into the key highlights from their third quarter report and why it just popped. They saw record revenues jumping 20% sequentially, which is is another way to say quarter over quarter. And they nearly tripled their earnings quarter over quarter as well, growing net income by 190%. A lot of this hyper growth in earnings is from building out their loan portfolio on their balance sheet, which again they can do now because they're a bank. An important note too is that their earnings were actually negatively impacted by $51 million this past quarter, meaning earnings could have been over $78 million for Q3 if it weren't for CECL accounting and revenue deferrals, which I believe are both non-cash expenses. Now this is actually a possibility I pointed out in my first video on Lending Club. It was a bit of a concern about earnings, saying CECL accounting might make them look worse than they actually were, and the market might have a negative reaction. But their consumer loan portfolio growth was actually so great that the numbers still looked amazing. To clarify this, CECL is a bank accounting method that forces you to recognize your lifetime expected credit loss on all of your new loans on day one. This kind of throws things out of whack because these costs are recognized all at once up front, but the revenue and net income you're supposed to generate from the same loans happens periodically and over years sometimes. It's a bit confusing at first, but I recommend you try and understand this. For the sake of time, however, we're going to keep going. They beat their own guidance on every metric with $3.1 billion in originations, $246.2 million in revenue, and $27.2 million in net income. They raised their full year guidance as well with $10.1 to $10.3 billion in originations, $796 to $806 million in revenue, and $9 to $14 million in net income. For context, they started the year predicting a net loss for 2021. But what I want to focus on is what this means for Q4 guidance, which is the next quarter. These numbers mean Lending Club is projecting almost flat growth quarter over quarter. They did $3.1 billion in originations this quarter. They did $246 million in revenue and $27 million in income. I highly doubt that they will show flat growth quarter over quarter, and I bet that they beat again in 3 months. Now, keep in mind that they do have seasonality to their business, and Q4 and Q1 often see lower demand for personal loans, so that could be counteracting the growth that they expect to see next quarter. But, again, I wouldn't be surprised if they beat once again. Their revenue breakdown continues to see incredible growth in their net interest income, which is interest from the loans on their balance sheet. In fact, net interest income, which is in light blue here, grew 42% quarter over quarter, outpacing non-interest income, which is revenue from their marketplace and sale of originations and things like that, which grew 14% quarter over quarter. So of course, their profitability is improving, but why is it improving? Let's dig into a couple metrics here so we understand what's actually happening in the business. First is net interest margin, which has improved from 3.33% to 7.06% in just the past 3 quarters. Net interest margin tells us how much interest they are collecting from their loan and debt products minus the interest they have to pay out to people who deposited money in things like savings and checking accounts with Lending Club Bank, because the deposited money is indirectly funding the loans that Lending Club issues. So to put this into an example, if I deposit $1,000 into a Lending Club savings account, they would take that $1,000, they'd pay me interest on it, but they would take it and use it to issue another loan for a higher amount of interest. So then the net interest margin is the difference between the interest they're getting on that loan minus the money they're paying me in interest for depositing that money. Personally, I kind of think of it as like a cost of goods sold, but for loans. And the point is their margins here are getting better. And in their Q3 call, which I also annotated and made a video on for investor community members only, that's linked down below if you want to join, the CFO said that they expect net interest margin to continue to inch upwards. The second metric that shows us why profitability is increasing is their operating leverage. If you have high operating leverage, when your revenue is increasing dramatically, your costs will stay relatively the same or not grow as fast as revenue, so therefore your margins are increasing. This is a result of having high fixed costs. Thus, costs over time should be a smaller percentage of revenue, as we can see here with the Lending Club. As they produce more revenue, their cost as a percentage of revenue decreases. So yes, their marketing costs have been increasing and expect that to keep increasing. But to put that into perspective, this past quarter, marketing as a percentage of originations was only 1.63% or 163 basis points. This means for every $100 in originations, Lending Club only had to spend $1.63 on marketing. Now let's get into the cons, and I may be biased, but I didn't see too much wrong with this past quarter. Again, they really just need to be better at advertising this sexiness of the AI and machine learning model that they have for Wall Street's sake. Artificial intelligence was said 0 times in the entire call, and they said machine learning once. For reference and context, Upstart's Q2 call, artificial intelligence was mentioned directly twice, and AI was mentioned 7 times. Give Wall Street buzzwords and they will give your company more attention. Another con is that sadly, it doesn't look like they'll be licensing their risk model to other banks, which is sort of like what Upstart's doing. On one hand, I think this is a bit of a missed opportunity, but on the other hand, I'm trying to understand why wouldn't they want to go this route. My guess would be that because Upstart cannot fund their own loans, it makes sense for them to partner with other banks to basically give them their software so they can create more originations, get more fees from originations from those third-party banks. But because Lending Club is now their own bank, they can fund their own loans, which means the loans that they originate using their software, they can fund it themselves and then keep it for themselves too, because they make 3 times more on the loans they keep than the loans they sell. So it wouldn't really make sense for Lending Club to license their software to other banks so that those banks get the originations, pay Lending Club a small fee, and then those banks get to keep the highly profitable loans. Instead, Lending Club can just keep their software to themselves, originate all of their own loans, sell 80% of them to institutions at the prices that they set in their marketplace, and keep the other 20% and make 3 times more on those loans. So if you think about it that way, it actually kind of makes sense why they wouldn't go the Upstart route. All right, now is it time to FOMO? Is it still cheap? And what am I doing with my position? Let's get into it. So this is what the comps table looked like when I first bought in versus roughly what the values look like now. In my initial video, I mentioned I was considering selling Upstart for more Lending Club because the thesis was that Upstart's valuation would contract and Lending Club's would expand, and that's pretty much exactly what happened. I didn't end up selling my Upstart yet though. Anyways, based on my estimates, Lending Club is still trading at roughly 4.2 times next 12 months EV to sales, despite a 40% jump in price after earnings. So it's after the jump. So yeah, it sure feels like FOMO right now because your time frame might be day to day, but in the long term, in the long run, I'd say it's arguably still cheap compared to its peers. So I've built out maybe 50 to 60% of my intended position by now, but I'm definitely still looking for a place to add more because this quarter only increased my conviction in Lending Club. Actually, the market's open right now and I'm watching it, and I was this close to pulling the trigger when it dropped back down to 40. I didn't though, but anyone in the investor community will be alerted of my buys and sells in real time. So with that said, congratulations to anyone who's been on the ride with me so far with Lending Club, and I'll see you in the next one. Subscribe.